Hello and welcome to our video on Introduction to Stocks. In this video, we intend to go over the concept of stocks and fundamentals of valuing stocks. Let's take this from the beginning. So you want to start a bakery as a business, but you don't have the capital to invest and get it kick-started. One option is to look for loans from banks, but banks do not easily give out loans to risky ventures. Plus, banks will also demand immediate and periodic installments for repayment of the loan, which you might or might not be able to fulfill for the first few months of your bakery business. For similar reasons, your friends and relatives might be hesitant to give out loans to you as well. In general, people are willing to invest and take higher risk or even forego immediate returns if there are prospects of lucrative eventual returns down the line. To leverage this behavior, markets all around the world have figured out that it is often cheaper and easier to raise capital for new ventures by going directly to people and offering them shares, also colloquially referred to as stocks. In this idea, instead of looking for loans for your bakery business, you gather a bunch of your acquaintances and propose to them the idea of investing in your bakery business as partners. This means that everyone who invests will get a share of ownership in the business in proportion to how much they have invested. So the business will now be co-owned by multiple people. Down the line, when business does very well, everyone will get a share of the profit in proportion to the share of ownership. Since now the business will be co-owned, that is, there will be multiple owners, they must all have some say in how the business is supposed to run and in its operational and strategic decisions. For example, should we open the bakery downtown where it's costly but also will lead to more sales? Or should we open it near a quiet residential street where it is much cheaper? Also, what kind of items should we carry or not carry? This would usually require all the owners to get together and have a discussion followed by a vote. A similar but more contentious problem emerges with respect to what to do with the profits. Some of the co-owners might want to take out their share of profits immediately, while others might propose to reinvest it and grow the business so that they can get increased profits back down the line. This entire dynamic of investing in someone else's business in hopes of getting shares of profits is what stocks and the stock market is all about. Via the stock market, regular people get a chance to purchase a share of ownership in another organization or company. They then are entitled to share of the profits, or share of capital return if the company or organization is sold to someone else. As co-owners, they also get to vote on some critical business decisions. In principle, this is all very similar to our bakery example. So coming back to our bakery example, if we now flip roles and say now you are one of the investors and this one acquaintance of yours has sat you down with a bunch of other people and has made this proposal of investing in his bakery business. He proposes a basic plan to show how he will be making this business a profitable one and proposes these mechanisms of sharing profits, or voting to reinvest to grow the business, all in proportion to the share you end up owning. How will you decide about the investment? Like every other decision, it kind of boils down to opportunity cost. You have to factor in how much return are you expecting. Is this expected return higher than the next best option available to you, like opening a fixed deposit or buying real estate, etc.? The return must be higher than at least rate of inflation. Also, one has to consider what is the time frame you are willing to hold, as returns might not be immediate, especially if in the first few years there is intention to reinvest the profits to grow the business. Plus, you also have to factor in the risk you are taking with this new venture. And this is what essentially investing in stock for any company is like, and the whole idea behind it. When you buy stock, you are buying a share of ownership in the company. From an investor point of view, stocks are often seen as either dividend stocks or growth stocks. If the company makes profits and shares those profits with all shareholders in proportion of their holdings, the payout is known as dividends. Stocks of companies which pay consistent dividends are considered as dividend stocks. On the other hand, if the company decides to reinvest the profits, then there will be no dividend, but the value of the company will grow, which in turn might be even better, as that might lead to stock price growing more than what dividend payout would be. This is how it typically works. Say a company generates profit of $5 per stock and the stock is priced at $100. Then this means that considering all aspects of risk and opportunity costs, investors in the market are happy to take a 5% return on their investment for stocks of this company. Company can pay out this 5% return as dividends. But if it decides to not pay a dividend and reinvest it to grow, then they need to increase their profits per share to add value to the investors. This is how it works. Say that by the end of the year, the company decides to reinvest the profit for next year and claims that by the end of next year we will generate a profit of $6 instead of $5 per share. On its face, this seems like a bad investment. Instead of getting 5 plus $5 over a period of 2 years, we will now get only 0 for first year and 6 for second year, which seems worse. But this increase in profit will also have a side effect. Since the market is willing to accept 5% returns for this stock, the price of the stock will increase to the point that profit per share is now again 5% of its cost. So investors will now be willing to buy the stock at $120, as $6 on 120 is still 5% return per stock. This immediately increases our holding from $100 to $120 in 2 years, which we can encash by selling the stock and get a profit of $20, which is better than 5 plus $5 we would otherwise have got if our company had paid out dividends. So the more a company increases its profit per share, the more dramatically its stock price will increase. For this reason, investors prefer to invest in growth-based stocks much more, as returns there can be much higher and much quicker. They, however, are also riskier. From a market analysis point of view, this phenomenon is captured via a statistic known as price-to-earnings ratio. Typically, a company with a higher price-to-earnings ratio means that company is not generating as much profit, but for some reason people are still holding on to the stock at a higher price. This is usually the case for stable giant conglomerates, such that even if profit return is smaller, the company is still a stable and less riskier investment, and hence people are willing to buy it for a higher price. It also means that if profit for the company increases, then its cost will increase by a much higher value as compared to a company with a smaller price-to-earnings ratio. For this reason, sometimes riskier companies which have high growth potential can also have a high price-to-earnings ratio. This brings us to the end of our video on introduction to stocks. In the next set of videos, we will discuss more things about stock markets and fundamental analysis. Thank you for watching.